Good morning, Econ students. It is February 6th, 2022, and I want to say that I really enjoyed working with everybody in the course, so just keep on doing what you're doing. And we only have 2 weeks left, so again, this week you're going to read chapter 15, 17, do a forum discussion post on something related to those chapters, and then continue to work on your common assessment. This will be our last week of the forum discussion, and then you can focus on that common assessment. But other than that, just jump in early to the post, and I'll look forward to commenting on your post. I was able to get to everybody this week, and I'll try to do that again this week too. So it's a little bit of insights, your chapters this week. We wrap up with the final market structure with monopoly. We asked the question whether monopolies exist in the United States. We'd say yes, that there are some types of monopolies, like the U.S. Postal Service has a monopoly to deliver mail to your mailbox. They're the only ones that are allowed to do that. Although other competitors you have, like UPS and FedEx, can deliver it to the door, they have that exclusive rights. There's also things such as patents that give a producer the right to have exclusive rights of production for a particular good for a period of time, usually about 20 years till it expires. And the textbook also mentions such things as like copyrighted material, the creative license to have that for an extended period of time, or trademarks, which I believe that somebody talked about branding in a post this week that I really appreciated. So, but with this market structure, we're still going to make that same rule: the marginal revenue equals marginal cost. The big difference is we don't have any other entrant in the market, so it is possible for a monopolist to earn an economic profit in the long run. Now, generally in the United States, we have concerns about that, and that's where the antitrust in this chapter comes in, and the Justice Department, looking at Herfman-Herschel ratios, looking at concentration ratios, Herfman-Herschel index, it shows that, and concentration ratios as a way to kind of measure the market power. It doesn't mean that the government's always going to intervene and try to break up a market, but they might at least challenge and look at whether there needs to be more competition in the market. I've kind of said along in the forum post that what I've kind of observed happening over many years, we tend to have more firms that are oligopolistic in nature. I think this is just more due to the size and scale, the ease of getting capital, and lower average total cost, economies of scale. So it kind of really makes it harder for kind of what we talked about last week, those barriers to entry to get into the market. So the concern is if oligopolies act as a monopoly, either explicitly or implicitly, there can be welfare loss in society. It's just, again, that other things are produced, but it's just it's going to be hard for some individuals who want to consume that good, or they're going to have to pay a lot of money to consume that good, and that takes away consumption from other areas. So another interesting thing I think you'll appreciate in this chapter is the idea of price discrimination. In order for price discrimination to exist, you have to have the ability to segment markets. Usually we can do this by age or by time of day. And then you have to have the inability to gauge an arbitrage. So if I, say we're to buy an airline ticket for a discount, whatever that discount would be that I was given, I can't go out and I can resell that airline ticket to someone else. So that's nearly impossible, especially in today's market about security. So, but it is possible to have price discrimination. Is price discrimination illegal? It depends. You would have to ask an attorney. If you go to McDonald's, they're not going to size you up and ask you how much you want for a cheeseburger each time. They're going to have consistent menu pricing. But there are definitely differences in price that companies try to use to extract more of that consumer surplus and more total revenue and ultimately more profit. So, and the textbook goes into some different dynamic pricing strategies that different firms use, which are quite interesting, especially with big data, how they can track your information and try to decide where do you fit along that spectrum and what is the best price to charge that individual. So, all right, with chapter 17, where most of you may be thinking about taxes this time of year. So I think this is really where the art of economics comes in play too, and where it really impacts you as individuals that are voting individuals decide how your tax dollars are going to be spent, how are they going to be allocated. But this chapter is going to look a lot about some of the concerns or questions about, that although with public choice policy, there may be failures within that market, such as the voting paradox, or that in terms of certain things that happen in markets within the government, such as rent seeking or log rolling, that still allow U.S. sugar to have quotas, which really aren't needed. But because we only pay maybe $10 a year extra for sugar, nobody really notices or nobody cares. But we can get sugar at a much lower price. But it's kind of one of those things that if you do me this favor, I will do you this favor in the log rolling. So it doesn't get to efficient outputs. Will we ever correct all this? Probably not, but it's kind of the way that our system works. But bottom line, chapter also looks at the questions of equity and fairness, who pays what in taxes. We do have what we call a progressive tax system with U.S. federal income tax. I was looking at the other day, and I think it's up to like the first $10,000 you pay 10%, and then it jumps to 12%, and then 22%. So the more that you make, the more that you're going to pay. There are some types of taxes that are regressive taxes. That means as the more you make, you actually pay a lower percentage of that tax. A good example of that would be the Social Security tax. I think it's somewhere around $140,000. That once you make more than that, the employer doesn't have to pay that, and you don't have to pay that anymore. So it represents a smaller percentage of your income after that. Many have argued that food sales taxes are an example of regressive taxes, that people generally buy the same amount of food, whether you are poor or you're rich. It's kind of a necessity. But for those at lower income levels, it represents a much greater burden. But it's those that make more, they're spending less on that tax of their overall income. So the last thing in this chapter, you're going to look at kind of the questions of equity and fairness, and that's where you hear in the news a lot of times, especially people like Elizabeth Warren say about redistribution of income and who should pay the percentage of tax. Warren Buffett has even brought this to attention. Is this right in our system? Some people question, well, why do certain individuals make so much money? Like Jeff Bezos. Is that right? Is that fair? Should so much control of the ownership be in just a few individuals? And it's an interesting debate in economics. I think you have to have incentives, and you have to have people that are willing to have opportunities, as long as opportunities exist. But that's where a lot of the divide comes in, about how do we distribute this income. And if you're going to look at something called the Lorenz curve, you're going to see that income is not equally distributed, which you would not expect. You want to have some incentives in place, that if those that are studying more, educating themselves more, doing better, are rewarded for that. But then it becomes a question about, are markets controlled in a way that does not allow, I would say that, the idea maybe meritocracy, the idea there are truly, opportunities for all people. So, but when you look at the net worth and how that's distributed in this country, it is really skewed. So it's like saying one person out of our class would control 80% of the net worth in the United States out of, 16 people that we have. And that's kind of the question, is this right? That should the worth be distributed more fairly between individuals? Is it right that one person or one individual has so much control over wealth and resources? So, all right, well, I'm interested to see what you post this week. So again, if you do have any questions, do send me a email. I'll get back to you that day or the next day at the latest. But again, I'm looking forward to jump in, and I may host like one more Zoom session sometime next week. I did that in the beginning of the course. We had about 5 people show up, but if you kind of want to review the common assessment and general questions about that, I might post something later this week or towards the end of the week to see if there's an opportunity that people want to meet. So other than that, talk to you online and have a great week. Take care.